Good morning. My name is David Peña, and I am the Head of Investor Relations at AEDAS Homes. On behalf of the whole company, I would like you to welcome to this strategic update which we are hosting virtually through live virtual tours, a wholly owned subsidiary of AEDAS Homes created to sell homes online. Almost a year and a half after the outbreak of COVID-19 in Europe, we have fortunately arrived at the moment when the population is getting vaccinated, families are getting back to normal life, and economies are starting to recover from the shock of the pandemic. Although uncertainty and risks are still significant, we believe the current business context is providing us enough capacity to understand the overall macro picture in a reasonable manner and build a new business plan in line with the expected evolution of the Spanish home building sector in the coming years. This sector, like many others, was impacted by COVID, but in the end has weathered the crisis well and come out stronger. To validate the opportunities the company has with this scenario, our top management team will be presenting today and giving us full detail on this strategic update, starting with David Martinez, our CEO. David will take us through the ramp-up the company has achieved to date, and then he will explain the goals for growing in the future. Next, Alberto Delgado, our Chief Operating Officer, will touch on the operational challenges and how the company is equipped to face them. Then, Sergio Galvez, Chief Strategy and Investment Officer, will take us through the opportunity to accelerate land investment. And finally, María José Leal, our CFO, will cover the financials of the new business plan and its potential for value creation before we move on to the CEO's key takeaways. These presentations will last for less than an hour, and then we will open it for Q&A. As you may see, we are running this virtual event at our live virtual tours platform, and to make the event feel more like a traditional Investors Day we will have loved to host, we will be taking questions addressed via Zoom, hopefully with your camera activated. We will be giving you access to the Q&A session only through Zoom. So if you want to ask a question, you will have to connect to the event via Zoom in the link you can find in the bottom of your screen. Let me remind you that this event is being recorded and will be available for playback on the same link as registration. Finally, before we get started, I would like you to inform that the speakers are the only ones not wearing a mask, and only the minimum number of staff are working inside the live virtual tours studio. We have worked hard to put together a compelling session, and we hope that you find it worthwhile and informative. So thank you for making time to join us today, and let's go ahead and get started.
Good morning, I am David Martinez, the CEO of AEDAS Homes. We're here today to share a strategic update with you because we as a company see an expansive cycle for the next 5 years. A cycle that we are positioned to capture and translate into value. And for that reason, we have defined an agenda today that's going to recap what we've done to get here and what we'll be doing going forward to seize this opportunity. We have defined a new business plan, a 5-year business plan that builds on our foundations, which I am going to cover in just a minute. Operationally, we are more than ready to take this challenge on board. And we are going to accelerate our land investment strategy in a disciplined way because we see an opportunity of paramount importance on the horizon. Everything that we are going to do will be governed by one very simple principle, which is the principle that has guided us for the last 5 years, and that is shareholder value creation. And this is where our focus is going to be going forward. So with this in mind, let me take you through what we have done to get here today. Our operational ramp-up phase is now complete. In terms of activity, we are already operating at the 3,000 units per year level. We have become Spain's largest listed pure-play home builder, and this is something we are really proud of. And we are even prouder when we look at the number of homes we delivered last year, hitting close to the 2,000 unit mark. A mark which a few years ago the market was skeptical of. Our land bank, I think, is best in class because yes, it is sizable and worth close to 2 billion euro. But more importantly, it is ready to build and located in the most in-demand areas. And we have successfully replenished it over the last 5 years in a very tailor-made way, cherry-picking each and every one of the plots. We have the land bank to put our new plan into motion going forward, but I also think we are going to have opportunities to increase it in the short term, and we'll get into that in a minute. We have a capital structure which I think everyone will say is robust, but it is not only robust, it is best in class when you compare it to our peers in the market. First, because of our LTV of 12%. Second, because of our credit rating. Nobody else has a credit rating better than ours. And finally, because we have managed to diversify our sources of funding and have been very successful in this. So I think our focus on financial discipline and shareholder value creation has allowed us to deliver excellent margins and to hit an EBITDA level of 133 million and return on equity of close to 9%. So that's what we've done, and it's where we are now. But let's look further ahead and frame this expansive cycle and this opportunity that we see for the next 5 years. We have, from a macro standpoint, some very favorable conditions for the housing market. Earlier this month, you witnessed the European Union approve the capital injection that the country needs, which is going to boost the Spanish GDP and boost investment in our sector as well. According to the Bank of Spain, GDP should grow by 6.2% this year and 5.8% in 2022. We have growing demand for new build housing, and there is a real imbalance between demand and supply, which is going to translate into pricing power. But it's even more positive for AEDAS in particular when you sit down and pinpoint where the demand is going to be concentrated. Make no mistake, it will be in the regions where we are operating today. And our brand recognition, the quality product with emphasis on sustainability and energy efficiency that we are bringing to the market, it's at the sweet spot of today's customer demand. And we believe that it will continue to be going forward. In this new cycle, we see small and mid-sized players facing challenges, and this will have an effect on the land market. Some of them will need to dispose of plots of land, and this will present an opportunity. And while it may seem like a paradox, the truth of the matter is the pandemic has actually increased the savings of the country. When you look at the household savings, we're actually at the highest levels in years, with interest rates at historic lows. So there is a lot of money that's going to be put into play. And in a potentially more inflationary environment going forward, real estate will be one of the safest asset classes to invest in. With that in mind, I strongly believe that AEDAS is in a unique position to capture and capitalize on this opportunity going forward. I said before, we are the biggest player, but we are not only the biggest, we are also the best position in the market because we focus on where the action is going to take place. We have already scaled up the platform. It wasn't easy, it wasn't cheap, but it is ready. It's what you call plug and play, and we are all set to take on board a significant amount of growth. In fact, when you look at the numbers today, we are already moving at a much faster pace than we were before. And we are pretty much in line with the revised targets that I'll share with you in just a minute. From a land standpoint, I've already mentioned the opportunity, and I think you are probably wondering when it's going to hit the market. We think it will be within the next 12, maximum 18 months, and we are ready to invest. And we have a very solid capital structure with north of 300 million in cash ready to be deployed to make the most of this opportunity. So with that, I am very pleased to announce to you what I believe is a very ambitious, but at the same time very realistic business plan. This plan is defined by a set of goals that will always be governed by the principles of financial performance and shareholder value creation. And these goals are: in terms of revenue, we are going to go from 750 million this fiscal year to 1.5 billion by fiscal year 2025. So yes, we'll be doubling revenues, and this is ambitious, but we also think it's realistic. And make no mistake, we will achieve this while protecting our margins. This top-line growth is not going to take place at the expense of the margin. As a result, our EBITDA will be in the range of 300 to 350 million. That's more than twice what it will be this fiscal year. And the implied return on equity will be moving from the high single digits to the high teens. In terms of shareholder remuneration, we'll be paying out 50% of our net income as ordinary dividends. And on top of that, potential extraordinary dividends based on our performance. With that being said, I think the devil is in the details. So I'm going to hand it over to my team and let Alberto, Sergio, and Maria Jose lay out for you everything we are going to do to capture this value that we see on the horizon.
Good morning, I'm Alberto Delgado, the Chief Operating Officer at AEDAS Homes. In the next few minutes, I'm going to show you how our operations platform is working now that it's fully scaled up, and explain why we are ready for more growth. In our first 5 years of operations, we've developed a strong platform based on a central strategy, decentralized execution, and local know-how. This is different from other home builders and puts us in a strong position for this next phase of growth. Our organization relies on the deep experience of our regional branches, who are responsible for the bottom line. These regional branches are supported by our central management team here in Madrid, who define our strategy and provide a rigorous system of checks and balances. Let me point out that we've just opened a 6th branch in the north of Spain, with the aim of growing our business in this area. With this decision, we further reinforced our national presence and demonstrated one of the foundations of our business model, its scalability. This decentralized, scalable model keeps our headquarters lean and allows us to grow locally in line with product volumes. This scheme has been key to our successful ramp-up, and it will be crucial to supporting future growth. Our decentralized approach is more agile, and it allows our regional branches to take the lead on decision-making and execution. This way of operating, where both the central team and the regional branches have important responsibilities and autonomy, has allowed us to attract and retain the best talent on the market. We have a number of levers we can pull to generate and maximize margins during the development process, and therefore improve our return on equity. These levers come down to 5 key concepts: local knowledge, cultivating strong relationships, digitalization and standardization, financial solvency and flexibility, and a robust framework for the development process. When we invest in land, we rely on our local teams to scout out opportunities, giving us the ability to close deals under very good terms. After we acquire the land, our detailed data analysis and market research is critical to defining the product as well as the target customer. We have an established framework which ensures feasibility and quality in the design phase, with standards set out in our White Book and Green Book. These guidelines ensure quality, energy efficiency, and sustainability across our all developments. And this will continue to provide a strong foundation for the company as we deliver larger volumes in the coming years. While we do tenders on construction projects, we've been moving more toward bilateral processes because this way we can work closely with tested architects and contractors. This lets us optimize our projects more precisely in the design phase and save time, while keeping tight control over cost, timing, and quality. Through our experience, we know that by getting things right at the beginning, we can de-risk the construction process down the road. Our sales and marketing strategy is based on a strong digital content platform that is very successful in generating leads and driving visits to our more than 50 local sales points. Our buy-in to digital has helped us to increase sales based on a powerful CRM, virtual visits, and digital signing technology. For example, to give you some color on our activity, in 2021, we are averaging between 3,000 and 3,300 sales visits each month. Because of our excellent location and attractive designs, in less than 5 years, AEDAS has become a recognized brand among customers who are willing to pay more for a new home. This brand awareness and premium pricing translate into an important lever for us during the development process. Our financial solvency and flexibility allows us to self-finance the first stages of construction works, and this gives us more control over pricing. For example, we don't have to sell significant volumes at lower prices in order to reach a sales threshold set by a bank to get the financing. And because we don't oversell at the beginning, we have the flexibility to raise prices and capture better margins on a significant number of units as the buildings goes up. In general, our procurement process is managed in a hands-on way by each regional branch, and at headquarters, we review their decision and sign off. We do this with our selection of architects, construction companies, and sales agencies. This efficient method allows us to take the best decision with tight control over cost and quality. And the final step in maximizing margins and return on equity is how we approach construction. You already know that we work with top construction companies and we sign turnkey contracts with a system of economic retention and guarantees. This reduces execution risk and assures quality and timing on our 70+ ongoing construction sites. These companies generally have a pipeline of projects with us and a long-term view of our relationship. Do you remember when I said that pacing our sales gives us control over pricing? It can also help us to manage our relationship with construction companies. Although turnkey contracts give us an excellent level of security, sometimes there are exceptional cases when a construction company might run into difficulty. In these rare cases, because we pace our sales process well and still have available units left, we can renegotiate if we need to, knowing that we have room to maneuver. This builds loyalty and allows construction companies to think long-term. Finally, as you know, we are leaders in offsite construction in Spain, and we plan for a quarter of our deliveries by 2023 to incorporate modern methods of construction or be built offsite. This is a more sustainable, efficient way of building and fits with our growing commitment to ESG. Now that I've explained the different levers we have to maximize our development margins, let me give you some color on how increases in construction cost and sales price are linked. Currently, there is a lot of noise about rises in the price of steel, lumber, and other raw materials, and I think it's worth commenting on. If we take a look at a cost breakdown of an AEDAS development, you can see that hard costs usually account for about 45% of the sales price. And in a development construction budget, without taking into account the contractor margins and general expenses, the cost of material versus labor is generally split 65-35. Taking into account that in Spain we currently have high unemployment and that production output of new homes is extremely low, in the short term we don't see a real risk of inflation related to labor costs. However, we expect to see an impact in terms of the cost of raw materials. And the question then is, how will this have an impact on our cost structure? Our calculations indicate that when the cost of this raw material rises by 4%, an increase in sales price of 1% will easily offset it. In other words, if we have material cost inflation in the coming months or years of between 15 and 20%, this could be offset with sales price increases of only 4 to 5%. If we look at the current context for housing in Spain, we have a strong demand post-pandemic, the best affordability ratios in years, and historically low interest rates, together with very low level of production. We are also seeing a clear preference for new build products, which are more spacious, more sustainable, and more energy efficient. Today's buyers want homes that are built for the 21st century. It's clear to us that we are looking at a scenario that we can manage well on both sides of the demand and supply equation, just as we've been doing all along. The elements I just mentioned have made our ramp-up a success. Today, we are at a level where our platform is well dimensioned and capable of delivering significant volume. We currently have close to 10,000 active units in different stages of the development process. And we are now at our run rate target for sales. This means we are selling over 250 units a month, which translates into 3,000 units a year. This strong sales level is supported by the volume and product mix we've put on the market with the right size developments in the right locations. And finally, our total accumulated deliveries is at over 3,400 units, which is right in line with the target we communicated 4 years ago at IPO. This shows our execution capacity and commitment to our stakeholders, and it's what a successful ramp-up looks like. We've demonstrated our operational capacity and our ability to deliver excellent margins. And because we are detecting growing demand in our footprint, we believe that now is the time to be more ambitious. This is why we have updated the targets in our business plan. Operationally, everything is in place now, and we are ready to take on a bigger challenge and create more value. Thank you.
Good morning. I am Sergio Galvez, the Chief Strategy and Investment Officer at AEDAS Homes. Today, I'm going to share with you why we believe the next 12 to 18 months will provide an unparalleled opportunity to invest in land, and why AEDAS is uniquely equipped to capture this opportunity. We see three key opportunities here. First, and most important, robust, growing demand for new build homes in Spain's main metro areas. Second, a scenario of reduced competition in land investment. And third, recently transformed ready-to-build plots coming on the market. We believe that there is a unique investment window, and we are in a privileged position, both operationally and financially, to take advantage of it. Let's start off by looking at what is most fundamental: demand for new build homes. First, in response to COVID, over the last 12 to 14 months, we have been updating our forecast for future demand. We have looked at recent projections for economic growth and demographic concentration, especially focusing on migration to cities and new household formation. We focused that analysis in the AEDAS nuclear footprint on just 80 municipalities. These 80 municipalities is where close to 60% of demand for new build homes in Spain will be in the next 5 years. In 2020, just 25,000 new build homes were delivered in these 80 municipalities. Compared to these 25,000 deliveries, our projections show average demand for 60 to 65,000 new homes each year for the next 5 years. This gives us a very bullish outlook. But the flip side of the coin is that in time, this growth in demand will put significant pressure on the land market. And as a result, land prices will start to climb. So, it makes sense for us to keep bringing land investment forward and concentrating it in the next 12 to 18 months. Actually, we have already started doing this when back in the second half of 2020, we were the only ones actively investing. Second, we have been seeing less competition from other players in land investment over the past 12 months, and we expect this to continue until early 2022. On the one hand, bigger peers are competing less than in the past. This is because they have either recently made large acquisitions or because they have slowed down or downscaled their business plans. This is confirmation that they are not planning to invest heavily in the coming years. And many mid-sized players who were very actively investing between 2016 and 2019 have changed course and are now more focused on developing and managing build-to-rent products, thus using up their existing land banks. On the other hand, there is much less competition from small local players because retail banks have become much stricter in their conditions for offering financing to these companies. Actually, the number of land investment opportunities on the market since Q1 2020 has increased because local players have not been able to gain access to financing. And third, we expect to see an increase in the volume of land investment opportunities in the next 1 to 2 years. Let me give you 2 main reasons why. Private equity firms with large land holdings will need to boost their land sales plan and make up for lost time since March 2020. And the land transformation processes started by professional landowners in 2016 are now beginning to produce results. This means we should start seeing good quality, recently transformed, ready-to-build plots coming to the market soon. AEDAS is uniquely positioned to make the most of the new opportunity scenario I have just explained. And that's because our disciplined and dynamic investment approach, which, to be perfectly honest, we haven't really changed since 2014. Once again, and sorry to everybody who has been following us since 2017, but I'm going to repeat our fundamental investment guidelines, and it probably won't be the last time either. We focus on the very best metro markets in our 6 regions, following a strict demand-driven criteria. We plan to keep focusing on the Madrid metro area, where we have been and will continue to be overweight. As a matter of fact, 40% of our investment in 2020 was made in Madrid. We also keep focusing on other key metro markets like Barcelona, Valencia, and Seville, and make selective investments in trophy assets in other Tier 1 areas such as Alicante and Mallorca. We have a hybrid, hyper-local approach to land sourcing. Our regional branches and our headquarters work together to identify the vast majority of our opportunities. In fact, 96% of the deals we close are proactively sourced off-market by our team. We have built our extraordinary land bank by sticking to our obsessive cherry-picking approach. Our margins and sales performance, both sales pace and HPA, have demonstrated the value of having invested 100% in cherry-picked assets in those plots where our teams wanted to invest. We target customers in the mid to mid-high segment, who for the most part are investing in their primary residence, their family home. As a case in point, over 90% of our 2020 investments were for the primary residence segment. We also invest only in fully permitted land and almost exclusively in ready-to-build plots that we can launch immediately, improving our return on capital employed. Actually, 92% of our land bank is ready to build, and 2/3 of the investments we have made since 2017 are either active or already delivered. That means we have extraordinary cash visibility. We invest in land that provides us robust economic returns with significant room for upside, and our improved margins for the last 3 years have demonstrated. And finally, we have a comprehensive due diligence process led in-house. This means we can be nimble and quick when we move on opportunities. On average, it takes us just 8 weeks from the time we identify an opportunity until we close on a new investment. So this means we are closing 1 deal every 10 days. These 6 guidelines have allowed us to build a balanced portfolio of cherry-picked plots with best-in-class and proven margins. Our land bank is regarded by everyone, analysts, peers, banks, and land appraisers, as the best land bank in Spain, and it will continue to underpin our leadership of the sector in the new cycle. Our team identifies and analyzes over 1,000 opportunities a year, and our track record speaks for itself. Since 2017, we have always overachieved our land investment targets, having invested over 125 million in land on average each year. This shows how successful we've been in replenishing our land bank year in and year out, not just in volume, but also in terms of its extraordinary level of quality. Over the last 5 years, many have said that we wouldn't be able to maintain the quality and the size of our original land bank. And for the last 5 years, we have enjoyed proving them wrong. One of the reasons we can be so bullish is because of the strength of our current land pipeline. Right now, we have 5 binding deals on the table, representing an investment of 60 million euros. Second, we have 30 non-binding offers for 140 million euros accepted by landowners and currently under exclusive due diligence. And beyond that, we have 70 potential deals at different stages of analysis, valued at around 600 million. And just to remind you of our first investment guideline, Madrid is heavily represented in this pipeline, accounting for a massive 47%. So, over the next 12 months, you can expect AEDAS to invest over 240 million in new land for 3,100 to 3,300 units. Most of this new land will be activated in the short term, thus improving our ROCE and further boosting our activity levels. Let's go to the center of the stage for a final recap. AEDAS has a unique capability to source and analyze opportunities according to strict investment guidelines. This means we are in a position that is well ahead of any other peer to take advantage of these opportunities and keep investing in the best assets. We are incredibly bullish on the new cycle, on the increasing residential demand in our footprint, and that's why we are raising our delivery targets. With this in mind, we will bring forward land investment so we can launch more developments and take advantage of that increased demand, repeating our success for the last 5 years. Thank you so much.
Good morning. For those of you who have not met me before, I am María José Leal, Chief Financial Officer at AEDAS Homes since 2018. As a follow-on to what we have shared with you this morning, I would like to cover our financial solidness and why it will enable us to benefit from the current opportunity, as well as our financial targets for the coming 5 years. Both David and Alberto have already covered how we have met all operational targets set at the IPO. This performance has also been reflected in our financial metrics published at the close of fiscal year 2020. Our yearly deliveries at an ASP of 340,000 euros have translated into 672 million revenue. Gross margin stood at 28.1%, on the higher end of the range provided at the IPO, and EBITDA came to 133 million euro, almost 20% over revenue. As part of our discipline when scaling up our business plan, we have managed to close fiscal year 2020 at a 12% net loan-to-value leverage. This low starting point provides us ample headroom to fund our expansion plan. I believe it is important to note that last May we attained a new milestone by issuing our first bond in the capital markets. This transaction marked the lowest coupon achieved by a home builder in EMEA, at 4%, on a 5.25-year tenor. With this bond issue, average corporate debt maturity now stands at 4.6 years, a time horizon that sufficiently covers the whole home building business cycle and gives us enough business flexibility. As a proof of our efficient and delivered capital structure, the instrument was rated by Moody's as Ba2, by S&P as BB-, and by Fitch as BB, which also stands as the best credit rating outcome for the industry in Spain. The uses of these proceeds were the repayment of existing loans amounting to 131 million euros. The remainder, which is roughly 189 million, has increased our available cash on balance, which is now 312 million euro, and will fund the investment plan Sergio has just explained in detail. This transaction becomes very relevant as it also enables us to keep diversifying our sources of funding. We now benefit from the banking lending platform with our developer loans and the existing revolving credit facility. Both instruments are used to fund working capital needs with a variable interest rate and very long-term maturity. Developer loans have an average maturity of 25 years, and the 55 million euro revolving credit facility has a maturity of 4.75 years. We also have access to the debt capital markets, both through the 150 million euro commercial paper program, which allows us to keep funding working capital needs and maturities varying from 1 to 24 months, and the recently issued high yield bond. These structures imply a fixed interest rate. All these factors will sustain this new expansion of our business plan. I would now like to focus on our financial targets for the coming 5 years. We have split these targets into 3 different time horizons. First of all, we lay out our targets for this year, 2021, which are already known by the market. I can confirm that as of today, we are on track to meet them, if not exceed them. We are talking about more than 750 million euro of revenue, more than 140 million euro of EBITDA, and more than 90 million of net income. Second, we lay out our targets for 2022 and 2023, which are again broadly in line with our previous market communication, and aim at attaining 1 billion of revenue and 200 million euro of EBITDA yearly. Although the targets are not new, we now have much more visibility over our ability to deliver them, since all projects to be delivered in these years have already been launched. Last, and on the back of the investment effort we are announcing today, we are offering new targets for 2024 and 2025, which represent a new stage in the growth of AEDAS that will now target circa 1.5 billion euro of revenues and circa 350 million euro of EBITDA per year. It is important to note that we already have in our land bank roughly 50% of the land plots to meet these targets, and additionally, 15% of them are part of the pipeline which Sergio just covered. Therefore, we have a firm conviction that these new targets are achievable. Other than confirming our short-term targets and raising the long-term aspirations on our usual KPIs, we now want to give you enhanced visibility over new financial metrics which are important to shareholders. Now that the operational ramp-up of the business is complete, management priorities will shift more towards financial performance and shareholder remuneration. In that spirit, we thought it was important to commit to a certain level of ROI and a dividend distribution policy. We see our ROI growing from circa 10% in 2021 to circa 18% in 2025 as we attain our new targets. Along the way, we will remunerate shareholders with a minimum ordinary payout of 50%, which will potentially be supplemented with extraordinary dividends, depending on market conditions and our cash generation capacity. By way of reminder, our AGM just approved the distribution of 62.5 million, which implies a 74% payout. According to the metrics of the business plan we are announcing today, these extraordinary dividends can amount up to 9.40 euro per share over the coming 5 years. Please note that this 9.40 euro is a maximum distributable amount and therefore cannot be seen as a commitment, but simply as a reflection of our capacity to generate operating cash flow over this period. As part of the business plan we are announcing today, we would like to explain the underlying inflation assumptions included in it. David has already covered the dynamics behind demand trends, and Alberto has covered our margins, building blocks, and protection capacity. First, I would like to remind you that hard costs weigh roughly 45% over our revenues. That is 1% increase in hard costs can be offset by increasing prices by only 0.45%. Considering the macro forecast published so far by most institutions, there is significant GDP growth expected for Spain over the coming 36 months. This GDP growth shall boost the employment rate, and general CPI is also expected to grow between 1.2 to 1.9% over this period. These factors have allowed us to include the following estimates of inflation over our selling prices and construction costs. Please note that we only apply house price appreciation over unsold stock and CCI on construction contracts not yet locked in, that is, deliveries occurring 24 months after each fiscal year. We can conclude that our capacity to offset construction cost inflation is proven to be very high, and in fact, we are even able to temporarily improve our margins on the units to be delivered to retail customers by an average of 140 basis points over the 5-year period ahead of us. Now that I have shared with you our financial targets for the coming years, I would like to share how these compare with existing sell-side analyst consensus and the implied multiples over our current trading price. As you all know, throughout 2020, after the uncertainty brought on by COVID-19, we saw most analysts revisiting their targets and adjusting them to a pessimistic scenario. As we have seen, these forecasts have not materialized, and we have seen our industry performing well overall in most countries, including Spain. However, most analysts are still showing operational and financial metrics well below our targets. We have compared our updated figures with the sell-side analyst Bloomberg consensus to determine the existing gap on EBITDA. As you can see, for fiscal year 2022, a period in which the visibility is extremely high given current coverage ratios, analysts still stand at an EBITDA of 157 million, while we are forecasting an EBITDA of close to 200 million euro, that is 30% higher. As I have explained before, we have launched all projects for the coming 3 years. That is, our visibility over these 3 years is extremely high, and therefore these targets now depend only on our execution capacity. We feel so good about our business that not only we are reiterating our goal of attaining 200 million euro of EBITDA by 2022, but we are now raising that number to as much as 350 million euro by 2025. We know that confidence and trust is something you don't ask for, but something you earn. So we will keep working hard to convince analysts and investors of the underlying potential in our business. While it is not my job to opine on the valuation of our company in the market, we thought it would be useful to factually illustrate where the company is trading relative to management's targets. As you know, the company is currently trading at a discount versus NAV of a little bit higher than 30% and a multiple of 1 times over book value. Our implied EV over EBITDA ratio for the next year is 6 times, and the number will go down to 3 times based on our long-term 2025 target. Our implied PE for the next year is 8 times, and the number will go down to 4 times based on our long-term 2025 target. If we just consider our ordinary 50% payout, the stock is currently trading at a dividend yield of 6% based on next year's financials and as high as 13% based on our 2025 target. By way of reminder, this ordinary dividend does not reflect the potential for the business to distribute extraordinary dividends. I believe all these ratios speak for themselves, and now I'll hand it over to our CEO so he can share his conclusions.
Given the economic recovery we are expecting post-COVID and the imbalance between supply and demand, I think you'll agree that the Spanish home building industry has a long, expansive cycle ahead. At AEDAS, we believe that this new cycle will offer us an unprecedented opportunity to create more value for our shareholders. We are at the right moment, operationally and financially, to scale up things and capture this opportunity. This is because our platform is now fully ramped up, because we are positioned in the right locations, and because we have the best land sourcing capabilities in the sector. And most importantly, because we are on the very strong financial footing and have ample firepower to capture the investment opportunities we have identified. The goals in the 5-year business plan we have announced today are very ambitious. But like everything we do, it's been designed bottom-up and therefore is realistic and achievable. Thank you for joining us today. And now we are ready to take your questions.